They didn't panic. They didn't warn anyone. They didn't tweet. They didn't go on TV. They quietly exited. And then the market collapsed. This has happened again and again in every major financial crash in modern history. The people on the inside always know first. The question is not if insiders exit before every market crash. The real question is how they know, why the public never sees it coming, and why the same pattern keeps repeating while ordinary investors are left holding the bag. Stay with me, because by the end of this video, you will never look at financial news, market forecasts, or so-called expert opinions the same way again. Before we go any further, if you want clear thinking, deep market psychology, and honest breakdowns without hype, take 1 second to like this video and subscribe. It helps this channel grow, and it tells the algorithm that content like this matters. You're watching MindSense, where we don't follow the noise, we follow the signals. Now let's talk about the first uncomfortable truth. Market crashes don't come out of nowhere. They are not random. They are not sudden accidents. They are slow-building events that insiders can see months, sometimes years in advance. By the time the public hears words like unexpected downturn or black swan, insiders have already positioned themselves safely on the other side. Think back to the 2008 financial crisis. While the public was being told the housing market was strong and stable, insiders at major financial institutions were selling mortgage-backed securities, shorting housing, and quietly reducing risk. They didn't guess. They knew. They saw loan quality collapsing. They saw defaults rising internally long before the data reached the headlines. And when the crash finally hit, it looked sudden to everyone else. The same thing happened during the dot-com bubble. Executives and early investors cashed out at insane valuations, while retail investors were being told that this time is different. The same script played again before the COVID crash, before the tech sell-off, and before every liquidity crisis you can name. Here's why this happens. Insiders don't rely on headlines. They rely on raw data, internal reports, and real money flows. They see declining demand before earnings miss. They see credit tightening before banks admit stress. They see liquidity drying up before volatility explodes. The public, meanwhile, is fed optimism until the very last moment. One of the most dangerous lies in finance is the idea that markets are transparent and fair. They are not. Markets are information hierarchies. The people closest to the source see the truth first. Everyone else reacts later. Insiders include corporate executives, institutional traders, large hedge funds, market makers, and policy insiders. They don't need conspiracy theories. They operate within legal gray zones, timing advantages, and privileged access. Even something as simple as knowing tomorrow's supply numbers, internal inventory stress, or upcoming policy decisions gives them weeks of advantage. Let's talk about forecasts, because this is where the manipulation really happens. Public forecasts are not predictions, they are narratives. When banks issue bullish forecasts at market tops, they are not helping you. They are creating exit liquidity. When media screams panic at the bottom, insiders are usually accumulating quietly. Watch what insiders do, not what they say. Insiders selling spikes before downturns. Executives don't sell because they're bored. They sell because risk is rising. They sell because growth is slowing. They sell because they can see numbers you can't. And here's something most people miss. Insiders don't all sell at once. That would raise alarms. They exit gradually, strategically, and quietly. By the time retail investors notice unusual volume or strange price behavior, the smart money has already reduced exposure. Market manipulation doesn't always mean illegal actions. It often means narrative control. Media is used to delay fear. Optimism is maintained to keep liquidity flowing. You're told to stay calm, zoom out, and buy the dip, while insiders are reducing leverage and increasing cash. This is why market crashes feel so brutal. They happen when liquidity disappears, when buyers vanish, when everyone realizes at the same time that the story they believed was never real. That's the moment insiders are already prepared for. Let's slow this down and really understand the psychology. Humans are wired to trust authority. When respected analysts, large banks, and famous investors sound confident, people feel safe. Insiders understand this. Confidence keeps the system stable long enough for them to exit. Fear only appears when it's too late. Think about how often you hear this sentence right before a crash. Fundamentals are strong. That's not reassurance. That's a warning sign. When fundamentals were truly strong, no one needed to say it. Another pattern insiders watch is leverage. Every crash is a leverage event. When borrowing increases, risk increases invisibly. Insiders track leverage rising across hedge funds, derivatives, futures markets, and shadow banking systems. When leverage reaches extremes, exits begin. Liquidity stress is another signal. When small market moves cause big price reactions, something is wrong. Insiders notice this immediately. Retail investors don't notice until headlines appear. Policy signals matter too. Central banks don't speak randomly. Insiders understand coded language. A single word change in a policy statement can signal tightening, slowing, or instability. By the time the public debates what it means, positioning has already happened. Now let's talk about leaks. Not movie-style leaks, but soft leaks. Guidance changes, private meetings, closed-door briefings, regulatory whispers. None of these need to be public to move billions of dollars quietly. This is why blaming retail investors for panic selling is dishonest. Panic selling happens after insiders leave. Retail investors react to damage already done. And here's the harsh truth. Most people are trained to lose in markets. They are trained to hold during peaks and panic during crashes. Insiders are trained to do the opposite. This channel, The Silent Collapse, exists to break that pattern. Not by predicting exact dates, but by understanding behavior, incentives, and structure. You don't need secret information to protect yourself. You need awareness. You need to understand when narratives become too perfect, when risk disappears from conversation, when greed replaces caution. Every major crash was preceded by confidence, not fear. Fear comes after. Now think about today. Ask yourself honestly, do markets feel cautious or do they feel confident? Are people being warned or reassured? Are risks discussed openly or dismissed? That emotional tone matters more than technical indicators. Insiders also track who is buying. When inexperienced money floods markets, risk rises. When speculative behavior increases, when leverage becomes normal, when complex products are marketed as safe, insiders take note. Another overlooked signal is silence. When bad news stops moving markets, it means the system is fragile. When good news fails to push prices higher, insiders know upside is limited. Let's talk about why the public never learns. Because after every crash, the story changes. Blame is assigned to random events, lessons are diluted, and then optimism slowly returns. The system survives by forgetting. But insiders never forget. They study past crashes obsessively. They know patterns repeat because human behavior doesn't change. This is not about fear. This is about clarity. Crashes are not evil events. They are reset mechanisms. They punish leverage, reward patience, and expose lies. The danger is not the crash itself. The danger is being unaware while insiders quietly exit. If you've stayed with me this long, it means you already think differently. And if this perspective resonates, share this video with someone who still believes markets move randomly. Conversations like this change mindsets. Before we wrap up, remember this. You don't need to beat insiders. You just need to stop playing their game. Reduce leverage, question narratives. Watch behavior, not headlines, and never assume stability is permanent. Leave a comment below with your thoughts. Do you think insiders are already exiting, or do you think the system still has time? Your perspective matters, and I read the comments. And if you found value here, share this video. Information spreads faster than fear, but only if people choose to pass it on. This is The Silent Collapse. Stay aware, stay calm, and stay ahead of the story.